I was just thinking about how usually when we talk about engineering, like whether you're designing a skyscraper or, I don't know, spanning a huge suspension bridge across a bay, the absolute primary goal is invulnerability.
Oh, absolutely. Rock solid.
Right. You want that structure to be totally solid. You want it to withstand earthquakes, hurricane force winds, basically whatever nature or human error throws at it. So the baseline expectation, like from the literal day the ribbon is cut, is just complete unyielding stability.
Yeah, I mean, it's the fundamental law of physical infrastructure. If a civil engineer builds a bridge that's inherently designed to, sway dangerously under a normal Tuesday morning commute, we'd consider that a colossal failure.
Like criminal negligence.
Exactly. Or a high-rise that just buckles if too many people stand on the left side of the building. We expect our physical world to be built for absolute resilience right out of the gate.
But then you step into the world of finance, and specifically the architecture of commercial banking. And suddenly, that whole fundamental expectation just gets flipped completely upside down.
It really does. It's a totally different paradigm.
Yeah, we're looking at a system that is emphatically not built like a concrete bridge. It's built more like, a massive house of cards in a windstorm. And this is the part that takes a minute to wrap your head around. That is exactly how it's supposed to be built.
It represents the absolute definition of a structural paradox. The very mechanism that allows a commercial bank to function, the engine that drives economic growth and funds mortgages, is the exact same mechanism that makes the institution inherently vulnerable to catastrophic collapse.
Which brings us directly to our mission for today. So welcome to today's deep dive. We are thrilled you're here with us, and honestly, we know exactly why you're tuning in.
You're staring down the barrel of a massive exam.
Exactly. A massive, comprehensive exam on financial systems. And sitting ominously on your desk right now is the incredibly intimidating Chapter 7, Regulation of Commercial Banks.
Straight from the Reserve Bank of India source documents.
Right, the RBI documents. It is just a sheer wall of text. It's heavy, it's deeply technical, and quite frankly, if you just try to read it front to back, it is completely overwhelming.
It's a formidable piece of source material, there is no denying that, but it's also the definitive, authoritative guide to the invisible plumbing of the entire Indian economy.
The plumbing, yeah, I like that.
Well, without deeply understanding the mechanics in this chapter, you just can't understand how the financial system operates on a daily basis, nor can you understand how it's safeguarded against total catastrophe.
So to conquer this material, we're not going to just read you the textbook. That would put you to sleep in like 10 minutes. Instead, we are going to act as your expert instructional designers today.
That's the goal.
Together, you and the two of us are going to mentally construct a highly detailed, text-based blueprint for the ultimate infographic study guide. We're going to visualize this whole thing.
We are going to map out the philosophy, the timeline, the dense jargon, and the hard data points so they actually connect logically in your mind.
By the time we finish this deep dive, you'll have this mental blueprint so thoroughly locked in that you will never need to reread that chapter again.
Because banking regulation isn't just some disconnected list of rules. It is a highly reactive, interconnected ecosystem. Every rule exists because something broke in the past.
So if we can build that ecosystem in your mind, the facts for your exam will just naturally fall into place. So, okay, let's unpack this. We need to start at the very top of your mental infographic.
The foundational layer.
Right. We need a title that immediately tells you what you are looking at and a core concept that anchors everything else.
Right.
So based on what we just discussed about that structural paradox, what are we calling this?
I think the overarching title at the top of your blueprint has to be Fragility by Design, the Architecture of Commercial Bank Regulation in India.
Fragility by Design. I love that. That perfectly captures the tension. Now, right under that title, we need the thesis statement.
The primary objective.
Exactly. The chapter has a main objective, and we need to distill it down into something you can essentially memorize. Let's get the exact framing for this.
Okay, here is the distilled, precise objective of Chapter 7 formulated into 2 sentences. Are you ready?
Hit me.
Commercial banks inherently operate with a fragile design by transforming short-term liquid deposits into long-term illiquid loans, necessitating strict regulatory frameworks to protect unsophisticated depositors and prevent systemic economic collapse.
Wow, okay. That's dense, but really precise. And the second sentence.
Consequently, the Reserve Bank of India employs a dynamic blend of microprudential regulations, stringent licensing, and continuous risk management mandates to balance financial stability with the evolving needs of economic growth.
I want to linger on that phrase, fragile design, Because, I mean, hearing it out loud, it sounds like an airline that sells tickets to 500 people for a 100-seat airplane.
That's a great way to look at it.
And the airline's entire business model is just constantly, sweatily betting that 400 people will decide not to fly on any given day. Like if everyone actually shows up at the gate at the exact same time with their luggage, the whole system just breaks down.
Your airline analogy is remarkably accurate, but to master this material, you have to push past the apparent absurdity of it and understand why society actually allows and even actively encourages this massive overbooking in the banking sector.
Right, because there has to be a benefit or we wouldn't do it.
Exactly. The text explains that banks perform what are called transformation functions. So think about the broader economy. Society has a vast pool of resources from savers.
People like you and me?
Right, people who want to deposit their money safely earn a little interest, but crucially, they might need that money back tomorrow to pay rent or buy groceries.
Yeah, like my savings account. I fully expect to be able to withdraw cash at an ATM at 2 a.m. if I want to.
Exactly, but society also has borrowers. A business needs capital to build a manufacturing plant, which will take 10 years to become profitable. Or a family wants to buy a house, but they need 20 years to pay off the mortgage.
So there's this massive time mismatch. The people with the money want it available tomorrow, but the people who need the money need to hold on to it for a decade.
Precisely. If banks only lent out money for the exact same duration that depositors agreed to lock it away, there would be virtually no long-term loans.
Because who locks their cash in a vault for 20 years without being able to touch it?
Right. You couldn't fund a modern housing market. Economic growth would just utterly stagnate. So the bank acts as the bridge. They take on that risk. They take short-term, liquid liabilities, your savings account, and transform them into long-term, illiquid assets, a 20-year mortgage.
And this is how a capitalist society efficiently allocates resources.
Yes, that is the core of it.
But, returning to the airline analogy, the moment there's a rumor that the bank is in trouble and all those short-term depositors run to the ATM on the same day, the bank doesn't actually have the cash.
It's not sitting in a vault.
Right. It's physically tied up in the concrete of a half-built factory or the framing of a suburban house.
And that is the inherent fragility. It is a necessary societal risk. And because we accept that risk to fuel growth, we absolutely require an incredibly powerful air traffic controller to ensure the planes don't crash.
And that controller is the Reserve Bank of India.
Exactly. That is why this dense wall of regulations exists.
Which brings us to how the RBI actually learned to control this traffic. So for the left side of your mental infographic, I want you to visualize a long, winding historical timeline.
Because the regulations the RBI enforces today didn't just drop out of the sky fully formed.
Definitely not. They were forged through decades of crises, evolving economic theories, and just a lot of trial and error.
Understanding this historical narrative is vital for the exam because it gives context to the current rules. The regulatory philosophy in India has seen massive paradigm shifts over the last century. So let's trace that evolution.
Okay, so I was reading the source material on the pre-1949 era, and honestly, it sounds like the Wild West.
It really was.
Before modern banking regulation, banking companies were simply governed by the Indian Companies Act, which dated all the way back to 1850. So let me make sure I'm picturing this right. A bank, which is holding the life savings of thousands of citizens, was essentially treated legally the exact same way as a company selling textiles or trading spices.
It was a vastly different, far more precarious landscape, yeah. There was no specialized oversight recognizing that systemic fragility we just discussed.
So a spice merchant goes bankrupt, the merchant loses their business, and their immediate creditors take a hit.
Right. But if a bank goes under, thousands of families are ruined and panic spreads to other banks. Treating them as ordinary companies led to immense vulnerability and frequent bank failures.
So when did the government finally realize they needed a specialized referee?
The first major step toward modern central banking happens in 1934. That is the year the Reserve Bank of India Act comes into effect.
Okay, 1934.
Yes. The RBI is established. It begins holding cash reserves for banks and acting as the lender of last resort. It was the beginning of a safety net, but the comprehensive deep dive regulation into how the commercial banks actually operated on a daily basis was still missing.
Which makes our next date the true watershed moment. If you're taking notes for this exam, you need to circle, highlight, and star this date, February 17th, 1949.
Yes. The passage of the Banking Regulation Act, commonly referred to as the BR Act. This is the absolute bedrock of all modern Indian banking regulation.
Because it finally separated them from ordinary companies.
Exactly. It gave the RBI sweeping, comprehensive powers to issue banking licenses, to conduct unannounced inspections, to mandate reserves, and to generally oversee the intimate health of the entire banking system. Everything we discussed today cascades down from the 1949 BR Act.
Okay, so the RBI has the power. As we move down the timeline into the 1950s, 70s, and 80s, the strategy shifts dramatically. We enter the era of nationalization.
A huge shift.
In 1955, the State Bank of India Act is passed, constituting the SBI. Then we see the Banking Companies Acquisition and Transfer of Undertakings Acts in 1970 and again in 1980, which essentially nationalized a massive swath of the private banking sector.
Right.
But why did the government feel the need to just take them over? Weren't the 1949 regulations enough to keep them in line?
Well, it wasn't about the regulations failing to keep banks safe. It was about the banks failing to meet the social and developmental needs of a newly independent nation.
Ah, okay.
Private banks naturally gravitated toward urban centers and large corporate clients because, well, that's where the easy profit was. They were largely ignoring rural India, agriculture, and small-scale industries.
Which is most of the country.
Exactly. The government realized that to develop the whole country, they needed direct control over the allocation of credit. Nationalization was a tool for financial inclusion and targeted economic development.
And speaking of pulling more institutions into the fold, the text highlights the year 1965. This is when Section 56 was inserted into the BR Act. What's the significance of Section 56?
Prior to 1965, cooperative banks were solely under the purview of state registrars of cooperative societies. They were entirely outside the RBI's regulatory umbrella.
Wow, really?
Yeah. Section 56 changed that, bringing cooperative banks under the RBI's jurisdiction specifically for their banking functions. It was an acknowledgement that a bank is a bank, regardless of its cooperative ownership structure, and it requires central oversight.
Okay, so following that push for inclusion in 1976, we see the passage of the Regional Rural Banks Act, or the RRB Act, further cementing the infrastructure for rural credit.
Right.
But then we hit the 1990s, and the source material frames this as a total philosophical earthquake. The economic liberalization of India begins, and the regulatory approach flips from a prescriptive mode to a prudential mode.
A massive paradigm shift.
Now, I struggle with this a bit. For decades, the RBI was micromanaging daily activities, like telling banks exactly what interest rates to charge, exactly who to lend to, and exactly how to operate. And suddenly they just step back and trust bank management. Why this sudden change?
Think about it less as blind trust and more as an acknowledgement of the complexity of a globalizing economy. A prescriptive approach is basically a command and control economy.
Which is super slow.
Exactly. As India opened its markets in the 90s, Indian banks had to suddenly compete not just locally, but globally. If the RBI is dictating every single interest rate and loan approval, banks cannot innovate, they cannot price risk accurately, and they just cannot compete.
So they needed to give them the steering wheel.
Exactly. The shift to a prudential mode meant the RBI changed its dialogue with the banks. They essentially said, we will no longer micromanage your daily business decisions or your commercial pricing. You have the freedom to operate in the market.
But there had to be a catch.
Oh, there was. They said, however, in exchange for that freedom, we are going to enforce much stricter boundaries regarding your corporate governance, the amount of capital you hold as a buffer, and your internal risk management systems.
So to use the car analogy, they gave the banks the steering wheel, but they mandated airbags, anti-lock brakes, seat belts, and a very rigid speed limit.
That is a perfect way to visualize it.
That makes total sense.
Yep.
But it seems the RBI was still quite nervous about this new freedom, because as we look at the licensing policy during this time, we enter what the text calls the stop-and-go era.
A very cautious period.
Right, so on your timeline, mark the years 1993, 2001, and 2013. During this entire 20-year span, the RBI only issued a tiny trickle of licenses, 10 in 93, 2 in 2001, and 2 in 2013. If they opened the economy, why was getting a banking license harder than getting into an Ivy League university?
Caution, pure caution. The RBI was navigating totally uncharted waters with the new prudential norms. They wanted to inject private competition into the sector, but they were deeply aware of the fragility we discussed at the start.
The house of cards.
Right. If they issued 50 licenses at once and 10 of those new banks failed because they couldn't handle the free market, it would cause a systemic crisis. So they opened a window, let a few highly scrutinized players in, closed the window, and just watched them for years to see how they performed under the new rules. It was a highly controlled experiment.
Which makes the pivot in the 2010s so striking. 2014 is an incredibly dense year on the timeline.
It was a very busy year for regulators.
First, the RBI shifts its philosophy away from just universal banks and issues guidelines for differentiated banks, specifically small finance banks and payments banks. We'll detail those later. But 2014 also brings a major new global regulation to India's shores. June 9, 2014. The Liquidity Coverage Ratio, or LCR, comes into effect.
And the LCR is a direct response to the 2008 global financial crisis, which we will unpack deeply in our definition section. But 2014 signals a modernizing, globally integrated regulatory framework.
And that confidence leads us to 2016, which marks the official end of the stop-and-go era. The RBI replaces that cautious window system with a continuous authorization or on-tap licensing policy for universal banks. Now, does that just mean anyone can start a bank whenever they want?
Well, not anyone, but the timing restriction was removed. On tap means there is no longer a closed window.
Right.
If a corporate entity believes it meets the incredibly stringent fit and proper criteria, the capital requirements, and the governance standards, it can submit an application for a banking license on any given Tuesday. The RBI will evaluate it on its merits rather than telling them to wait a decade for the next licensing round.
So it's a huge sign of maturity.
Exactly. It reflects maturity in the regulatory framework. The RBI is now confident in its ability to supervise new entrants at any time.
Okay, moving along. Then, in 2017, the system faced a massive buildup of bad loans, leading to the Banking Regulation Amendment Act of 2017. This empowered the RBI to issue specific directions to banks regarding the resolution of stressed assets, basically forcing banks to deal with their bad debts rather than hiding them under the rug.
And this liberalization and tightening dance continues. By 2019, the licensing for small finance banks also becomes on tap, showing the RBI was really satisfied with how that differentiated experiment was actually going.
Now we cross into the 2020s, and the timeline just accelerates dramatically. In 2020, amidst the pandemic, another Banking Regulation Amendment Act enhances the RBI's oversight over cooperative banks, giving them far more teeth regarding management and capital. They also issue a major discussion paper on governance that year.
Which is crucial for internal risk.
Right. Then, October 1st, 2021, is your next critical exam date. The Net Stable Funding Ratio, or NSFR, comes into effect. It's the sister regulation to the LCR.
Yep, the long-term liquidity piece.
In 2022, responding to the tech boom, digital banking units, or DBUs, are formally announced in the union budget.
You can really see the regulator trying to keep pace with technology and complex global risks here.
Which is why 2023 looks like an absolute sprint. You need 4 distinct bullet points for this year alone. Ready?
Go for it.
February 17th. Final guidelines on interest rate risk in banking book, or IRRBB, are issued. April. The framework for green deposits is issued, showing climate risk finally entering the banking sphere. June 8. A comprehensive framework for compromise settlements and technical write-offs is published. And November 7, the Master Direction on IT Governance is issued, dealing aggressively with cybersecurity and technological resilience.
It was a massive year. And finally, we arrive at the current edge of the timeline, 2024. In April, the RBI issued the specific, rigorous eligibility criteria for small finance banks to voluntarily transition into universal banks.
Oh, like graduating to the big leagues.
Exactly. And crucially, October 1st, 2024, is the target date for full compliance with the new Key Facts Statement, or KFS, guidelines for all new retail and MSME term loans.
Okay. I am looking at this timeline we just built, and it is a masterpiece.
Yeah.
But here is the catch. Here's where it gets really interesting for the exam.
Right.
Behind every single one of those dates, and behind every acronym like LCR, NSFR, and IRRBB, is a massive, tangled web of technical jargon.
You absolutely cannot pass this exam just by memorizing the chronology. You have to understand the mechanics of the language.
Exactly. So for this next major section of our mental blueprint, we are going to build an exhaustive glossary. The way we'll handle this: I will pose the concept, we'll discuss the practical reality of it, and then you'll provide the precise, exam-ready definition directly derived from the RBI text.
And you must retain the exact phrasing, as multiple-choice questions will frequently try to trick you by altering a single word. Precision is everything in regulatory exams.
Okay, let's start with those foundational concepts from our Fragility by Design discussion. We talked about the time mismatch. So what is the formal definition of maturity transformation?
Maturity transformation is the core banking act of using short-term instruments, specifically liabilities like demand deposits, which can be withdrawn by the customer at any time to fund long-term assets, such as a 20-year housing mortgage or a corporate infrastructure loan.
Right, so that's all about time, but then the text immediately brings up liquidity transformation. Are those not just two ways of saying the exact same thing?
They are intimately related but conceptually distinct, and the exam will definitely test you on the difference. Maturity is about time. Liquidity is about marketability or ease of converting to cash.
Okay, how so?
Well, you can have an asset with a very long maturity, like a 30-year U.S. Treasury bond, that is incredibly liquid because you can sell it in a millisecond on the open market.
Oh, I see.
So, liquidity transformation, therefore, refers specifically to the process of a bank converting illiquid assets, meaning customized loans that cannot be easily or quickly sold to a third party for cash into liquid liabilities, which are the deposits that customers expect to be able to withdraw in pure cash on demand.
Okay, that distinction is super clear. Now, let's look at the customer's perspective. When I put my money in a bank, I have no idea who they are lending it to. I don't see their spreadsheets. Which brings us to asymmetric information.
Asymmetric information is a fundamental economic scenario where one party to a transaction possesses greater material information than the other. In the context of banking regulation, this refers to the reality that banks have complex, opaque, highly leveraged balance sheets and intimate knowledge of their borrowers' creditworthiness.
While someone like me, the unsophisticated depositor, lacks the time, resources, or specialized expertise to monitor the bank's true financial health.
Exactly. You are at an informational disadvantage.
And because I don't know what's going on behind the curtain, if I hear a rumor that the bank made bad loans, my logical response is to run to the branch and demand my cash before everyone else does. Thus, a run on a bank.
Precisely. A run on a bank is an event triggered by the sudden erosion of public confidence, where depositors collectively and simultaneously attempt to withdraw their funds due to the perceived inability of the bank to refund deposits on demand.
And because of the transformation functions we just defined, they actually can't.
Right. Crucially, no bank actually has the physical cash on hand to pay every depositor at once, making a bank run a self-fulfilling prophecy of institutional failure.
Okay, so society realizes bank runs are catastrophic. To stop them, the government introduces deposit insurance. If I know my money is insured by the government, I won't panic. But fixing that problem creates a brand new behavioral problem for the bank executives. Define moral hazard.
Moral hazard is the risk that mechanisms deliberately put in place to repose public confidence, specifically depositor insurance and the central bank acting as a lender of last resort to provide liquidity support, actually encourage excessive, reckless risk-taking by bank management.
Because they feel invincible.
Exactly. They are incentivized to chase high-risk, high-reward loans because they know they are largely insulated from the full, fatal consequences of failure, as the taxpayer or the central bank will step in to save the depositors.
It's the ultimate heads I win the bonus, tails the taxpayer absorbs the losses scenario. So, to counter moral hazard, we need regulation. The text splits this into two buckets. Let's start with microprudential regulations.
Microprudential regulations are targeted regulations designed to examine how individual specific institutions respond to exogenous shocks, with the primary singular goal of ensuring the soundness, safety, and solvency of that single individual entity. It is basically looking at the health of a specific tree.
But the 2008 global financial crisis proved that wasn't enough, right? You could have a bunch of healthy-looking trees and the forest still burns down. Which brings us to the second bucket, macroprudential regulations.
Correct. Macroprudential regulations are aimed at a wider systemic scope. They are designed explicitly to prevent the buildup of systemic risk where the financial system as a whole is impaired. It acknowledges the interconnectedness of finance, that the collective actions of individually safe banks can actually create massive systemic vulnerabilities.
Let's get into the actual tools the RBI uses. Banks are forced to hold certain amounts of reserves. The most basic is the cash reserve ratio, or CRR.
The cash reserve ratio, or CRR, is a strictly prescribed portion of a bank's net demand and time liabilities, or NDTL.
Which is just a technical term for their total deposits, right?
Yes, exactly. So it's a portion of their total deposits that must be maintained purely in the form of liquid cash balances with the Reserve Bank of India. It acts as an ultimate primary buffer against sudden withdrawals and serves as a direct tool for the RBI to manage monetary policy and market liquidity.
But there is a second ratio, the statutory liquidity ratio, or SLR. Now, if they already have cash parked with the RBI, why do they need SLR? What exactly are they holding?
Well, the statutory liquidity ratio, or SLR, is a prescribed percentage of a bank's NDTL that must be maintained in India, not necessarily in raw cash, but in the form of investment in unencumbered approved securities, which are overwhelmingly government bonds, as well as permitted holdings of cash, gold, and other notified instruments.
Unencumbered. That feels like a keyword.
The word unencumbered is vital for the exam. It means the bank owns these assets free and clear. They haven't pledged them as collateral to borrow money somewhere else. SLR ensures banks have a pool of safe assets they can easily sell in a crisis, and functionally, it also guarantees a captive market for government debt.
Moving from what banks hold in reserve to the loans they make. Sometimes loans go bad. The RBI has a very strict framework for this called income recognition and asset classification and provisioning, almost universally referred to as IRACP. How does a bank actually define a bad loan?
IRACP represents the strict prudential norms requiring banks to objectively identify stressed assets, which are classified as non-performing assets, or NPAs.
So it's not just a subjective guess.
No, this classification is not based on the bank's gut feeling. It is based objectively on the record of recovery, meaning how many days past due is the payment. Furthermore, IRICP mandates that banks make financial provisions.
Provisions meaning setting aside money.
Yes, proactively setting aside capital from their profits depending on the aging of that NPA and the actual availability of realizable security backing the loan.
So the longer a loan goes unpaid, the more capital the bank has to lock away to cover the impending loss. And speaking of capital, that is governed by massive international agreements. We need to talk about the Basel Capital Adequacy Framework.
The Basel Capital Adequacy Framework is a set of foundational international regulatory guidelines established by the Basel Committee on Banking Supervision. Under this framework, a bank's minimum capital requirements are intrinsically linked to the risk profile of their specific asset classes.
So not all loans require the same capital.
Exactly. A risky, unsecured corporate loan requires the bank to hold more capital than a safe mortgage. Evolving through three major iterations, Basel ST2 and 3, the framework ensures banks consistently hold enough capital to act as a robust, loss-absorbing buffer, protecting depositors against unexpected economic shocks.
I really want to spend a moment on that evolution from Basel's to Basel III because it's a fascinating story of the global regulatory community having to really learn from catastrophic mistakes. It wasn't just a tweaking of numbers, the entire philosophy changed, didn't it?
What's fascinating here is that it is perhaps the most critical narrative in modern financial history. Think of Basel I, introduced in the late 1980s, as very rudimentary. It almost exclusively focused on credit risk, the simple risk that a borrower wouldn't pay back a loan. It categorized loans into broad buckets and attached a capital charge.
Right. Pretty basic.
Basel II got significantly more sophisticated. It allowed advanced banks to use their own internal models to calculate risk, and crucially, it introduced capital charges for operational risk, things like fraud or IT failures, and market risk.
But then 2008 happened, and banks that looked completely fine under Basel's second standards collapsed overnight.
Why?
Because Basel II had a massive glaring blind spot. It ensured banks had enough capital, meaning net worth on paper, but it completely ignored liquidity.
Ah.
In 2008, banks had the capital, but their assets were tied up in toxic mortgage-backed securities that suddenly had zero buyers. When the short-term funding markets froze, these banks couldn't raise the literal cash needed to pay their daily obligations. They faced a fatal liquidity crunch. You can be solvent on paper and still go bankrupt if you run out of cash.
Wow, so that completely changes the game.
Therefore, Basel III was a total overhaul. While it tightened capital rules, its revolutionary step was introducing strict macroprudential liquidity ratios to ensure banks could actually survive a panic without central bank bailouts.
And those two revolutionary liquidity ratios are our next definitions. Let's start with the liquidity coverage ratio, or LCR. The liquidity coverage ratio, or LCR, is a macroprudential liquidity metric introduced under Basel III. It explicitly mandates that banks must hold a sufficient reserve of high-quality liquid assets, or HQLA.
And HQLA means assets that can be instantly converted to cash with no loss of value.
Correct. They need this reserve to allow the bank to survive a severely stressed, catastrophic liquidity scenario lasting for exactly 30 days. It is the bank's short-term survival kit.
And the companion to that is the net stable funding ratio, or NSFR. If LCR handles the 30-day panic, what does NSFR do?
The net stable funding ratio, or NSFR, focuses on the long-term structural foundation. It requires banks to maintain a stable funding profile in relation to the composition of their assets and off-balance sheet activities over a one-year horizon.
So stretching it out over a year.
Yes. Simply put, it prevents banks from funding long-term illiquid assets using volatile short-term wholesale funding. It forces them to match the duration of their funding with the duration of their loans.
You mentioned earlier that Basel II introduced operational risk, the risk of internal failure, fraud, or system collapse. The text notes that the new standardized approach to calculate capital for operational risk uses two specific components. Define the business indicator component, or BIC, and the internal loss multiplier, or ILM.
Calculating operational risk is difficult because you are trying to predict human error or cyber attacks. Under the new standardized approach, the business indicator component, or BIC, is used. This component uses readily available financial statement-based metrics, like a bank's size, income, and fee generation, to act as a mathematical proxy for the sheer scale and complexity of a bank's operations.
Okay, so a bigger, more complex bank has a higher BIC. And the second factor?
The second factor is the internal loss multiplier, or ILM. This is a scaling factor based directly on the bank's actual historical internal loss data over a set period. If a bank has a history of high operational losses due to poor internal controls, their ILM goes up, which mathematically increases the total amount of capital they are forced to hold.
Makes sense. Okay, let's shift gears to a bank's investment portfolio. They take our deposits and invest them in bonds and securities, but they can't just treat them all the same. They're legally mandated to categorize their entire investment portfolio into three distinct buckets. Let's define them. Held to maturity, or HTM, available for sale, or AFS, and fair value through profit and loss, or FVTPL.
These classifications dictate how an investment impacts the bank's balance sheet and profitability. Held to maturity, or HTM, is a classification for securities that the bank has both the explicit positive intent and the actual financial capacity to hold continuously until they mature. Because they aren't going to sell them, day-to-day market price fluctuations don't immediately impact their recognized profit.
Right, because they are riding it out to the end anyway.
Exactly. Available for sale, or AFS, is a middle ground. It is for securities held for an indefinite period that the bank might decide to sell in response to sudden liquidity needs, changes in interest rates, or shifts in funding sources.
And the third one?
Finally, fair value through profit and loss, or FVTPL, is a classification for securities held primarily for short-term trading and speculation. Because the intent is to trade, any change in their daily market value must be immediately recognized and directly impact the bank's current profit and loss statement.
Now let's talk about the loans banks give to us, the consumers. Say I go get a floating rate mortgage. For a long time, banks used their own internal formulas to decide my interest rate. But the RBI changed the rules and introduced the external benchmark rate. Why and what is it?
An external benchmark rate refers to independent, publicly known market benchmarks, such as the RBI's policy repo rate or the transparent yields on government treasury bills. The RBI mandated that banks must link all new floating rate personal, retail, and MSME loans strictly to these external benchmarks.
To stop them from essentially making up the numbers.
Exactly. The reason is simple. When banks used internal benchmarks, if the RBI lowered rates to help the economy, the banks would invent excuses about their internal costs and refuse to lower the mortgage rates for consumers, just pocketing the difference. Tying it to an external, public number ensures complete transparency and guarantees the immediate, effective transmission of monetary policy.
All right, what happens if a bank ignores all this risk management and starts driving toward a cliff? The RBI has a system called Prompt Corrective Action, or PCA. Sounds intense.
It is designed to be intense. Prompt Corrective Action, or PCA, is a stringent regulatory framework based on predetermined, rule-based, structured early intervention. It applies a series of mandatory and discretionary actions the moment a bank breaches specific, predefined risk thresholds related to capital adequacy, asset quality, and leverage.
So it's an automated alarm.
Yes, essentially an automated, escalating alarm system. Depending on how severe the breach is, the RBI can restrict the bank from paying dividends, stop them from opening new branches, or even remove management entirely, stepping in before the bank becomes completely insolvent.
Wow. And what if the problem isn't the bank, but a borrower who's just a bad actor? The RBI has a specific classification for this, the willful defaulter.
A willful defaulter is a very specific punitive legal and regulatory classification. It applies to a borrower who has defaulted on their loan obligations despite having the actual financial capacity to honor them.
Right.
It is not for someone whose business honestly failed.
Was malicious.
Right. It also explicitly includes borrowers who have actively diverted or siphoned off borrowed funds for purposes other than the specific project they were intended for. Crucially, under recent updates, it even includes entities or promoters who legally committed to infuse their own equity capital into a project but subsequently failed to do so, leaving the bank holding the bag.
Okay. To protect everyday borrowers from getting trapped in confusing predatory loans, the RBI mandated the Key Facts Statement, or KFS.
The Key Facts Statement, or KFS, is a legally mandated, highly standardized, plain language document that must be provided to borrowers before a contract is signed. It must contain the essential, critical information regarding the loan agreement in an easy-to-understand format.
Like the true cost.
Exactly. Most importantly, it must include a clear, all-inclusive computation of the annual percentage rate, or APR, which reveals the true cost of the loan, including all hidden fees, and the full, detailed amortization schedule.
And our final term for the glossary, which deals with the risk banks face when interest rates change globally. Interest Rate Risk in Banking Book, or IRRBB.
Interest Rate Risk in Banking Book, or IRRBB, refers to the current or prospective risk to a bank's capital base and its core earnings arising from adverse, unexpected movements in market interest rates. These rate changes directly affect the bank's non-trading banking book positions.
Because the value of those loans goes up or down.
Right. When rates move, they alter the economic value, or EV, of the bank's long-term assets and liabilities, and subsequently compress their net interest income, or NII. It requires highly sophisticated hedging to manage.
Incredible. That is a massive glossary. But having those conceptual explanations followed by the exact, precise definitions is really the only way you're going to tackle the multiple choice section of this exam.
Absolutely.
Now let's move to the next part of our infographic blueprint. I suggest we create a cast of characters section. Throughout that timeline and glossary, we've thrown around a lot of different acronyms for different types of banks and regulatory bodies. We need to map out the players on the board.
Identifying the entities and clearly understanding their specific jurisdictions and limits is critical. It clarifies the structure and hierarchy of the entire financial ecosystem. Let's map them out.
The undeniable protagonist of our story sitting at the top of the board is the Reserve Bank of India, or RBI.
Yes, the Reserve Bank of India is the apex central banking authority and the supreme regulator. Its primary roles in the context of Chapter 7 include issuing and revoking commercial banking licenses, meticulously setting the prudential norms we just defined, conducting inspections, and acting as the lender of last resort to ensure absolute systemic stability.
Below them, we have the absolute giants of the industry, the State Bank of India, or SBI, and the nationalized banks. How are they legally distinct from a private bank?
These constitute the public sector banks. What makes them legally unique is their foundation. They are constituted under specific, dedicated parliamentary enactments, such as the State Bank of India Act of 1955 and the Bank Nationalization Acts of 1970 and 1980.
So they aren't just normal companies.
Right, they're statutory bodies rather than being incorporated merely as public limited companies under the Standard Companies Act and governed solely by the Banking Regulation Act.
Next on the board, targeting a very specific demographic, are the regional rural banks, or RRBs.
Regional rural banks are specialized, regionally focused institutions established primarily to develop the rural economy. Their mandate is providing targeted credit and banking facilities strictly to agriculture, trade, and small industries in rural sectors. Their defining feature is their unique tripartite ownership structure, which we'll cover in the data section.
And an even smaller, highly constrained entity, local area banks, or LAVs.
Conceived as an experiment in 1996, local area banks were designed as incredibly low-cost structures, specifically for rural and semi-urban financial intermediation. Their absolute defining regulatory characteristic is their severe geographic restriction. They are legally limited to operating branches within a maximum of 3 contiguous districts.
Now we get to the newer, modern players introduced post-2014, which we discussed on the timeline: small finance banks, or SFBs, and payments banks, or PBs.
These represent the era of differentiated banks. They were introduced to promote highly targeted financial inclusion. Small finance banks are designed to provide basic banking activities, including accepting deposits and lending, but specifically geared toward underserved sections like small business units, small and marginal farmers, and micro-industries. They operate under strict mandates regarding the size of the loans they can give.
And payments banks.
Payments banks, on the other hand, are a fascinating structural innovation. They provide targeted remittance services and basic savings accounts for migrant labor workforces and low-income households.
But there's a massive catch with them.
A huge one. They face an ultimate restriction. They are strictly prohibited from undertaking any lending activities whatsoever. They cannot issue credit cards or loans. Their risk profile is therefore entirely different.
Okay, I have to pause and ask a logical question here. You look at this incredibly crowded cast of characters: universal banks, public sector giants, RRBs, labs, SFBs, PBs. How do all these different players coexist in the market without constantly stepping on each other's toes, fiercely cannibalizing the market, and just creating chaos? Why not just have five massive, heavily regulated banks do everything?
If we pull back and connect this to the bigger picture, it is all about the philosophy of differentiated banking.
Hmm.
For decades prior to 2014, the RBI essentially only issued licenses for universal banks. These were massive entities expected to do everything for everyone.
Right.
But the reality of the Indian demographic proved that model inefficient. The RBI realized that a massive, sophisticated multinational bank operating out of a skyscraper in Mumbai is simply not optimized nor structurally incentivized to efficiently underwrite a tiny 50,000 rupee microloan to a local farmer in a remote village, or to cost-effectively process millions of microscopic 500 rupee remittance payments for migrant workers.
It's just not worth their time.
Exactly. Differentiated banking acknowledges that reality. It creates specific, specialized tools for specific economic jobs. It is the fundamental difference between trying to use a Swiss Army knife for every task in a workshop versus having a specialized scalpel, a heavy hammer, and a precision wrench. They coexist beautifully because they are fundamentally targeting different structural gaps in the financial inclusion landscape. The universal bank handles the billion-dollar corporate loan. The payments bank handles the daily remittance.
That analogy clarifies it perfectly. Okay, let's round out our cast of characters with the supporting entities that keep the system running. We discussed deposit insurance earlier to prevent bank runs. The entity actually holding that bag is the Deposit Insurance and Credit Guarantee Corporation, or DICGC.
Correct. The DICGC is a specialized, wholly owned subsidiary of the RBI. Its singular statutory purpose is to provide robust deposit insurance. It acts as the ultimate safety net to protect unsophisticated depositors against the total loss of their funds in the rare, catastrophic event of a commercial bank failure or liquidation.
And when we define external benchmark rates, we mention the organization that actually calculates and publishes those numbers so banks can't cheat. Financial benchmarks, Indy or Private Ltd, or FBIL.
FDIL is the independent, specialized organization recognized by the RBI that acts as the official benchmark administrator. They are tasked with rigorously calculating and publishing the critical, publicly known benchmark market interest rates, like the Treasury bill yields or the MIBOR, which banks are now legally mandated to use to price their floating rate loans.
We also have a group of apex institutions called All India Financial Institutions, or AIFIs.
AIFIs are massive ATEX development financial institutions that act as primary financial intermediaries for highly specific, critical sectors of the broader economy. They are comprehensively regulated and supervised by the RBI and include major national entities like NABARD for agricultural refinance, NABFID for massive infrastructure funding, NHB for the housing sector, and SEBI for small-scale industries. They are the wholesale engines of sectoral development.
And finally, the entities that exist almost entirely to solve our asymmetric information problem in lending. Credit information companies, or CICs.
CICs, commonly known as credit bureaus, are specialized institutions regulated by the RBI that collect, meticulously collate, and maintain vast databases of credit information on individual and corporate borrowers. By analyzing this data and providing credit scores and reports to member banks, they drastically alleviate the problem of asymmetric information. They allow lenders to pierce the veil and make informed, data-driven risk assessments before extending credit.
Okay, listener, I hope you have stretched your hand and have a fresh pen ready, because we're moving to the fifth major section of our infographic blueprint. This is the data dump.
The numbers.
Exactly. It's time for the hard, unforgiving numbers. If you have ever taken a regulatory exam, you know they absolutely love testing on exact percentages, strict deadlines, and precise limits. We have extracted the vital statistics you need to know from Chapter 7.
These empirical data points are frequently tested because they represent the hard, objective boundaries of regulation. We will go through them systematically, but I will also explain the logic behind the numbers so it actually sticks in your memory.
Let's hit the first one. Bullet point 1, 50, 15, 35. That's 50 to 15 to 35.
This specific ratio represents the exact legally mandated equity contribution for regional rural banks, or RRBs. It dictates the ownership split. Exactly 50% must be owned by the central government, exactly 15% by the respective state government, and exactly 35% by the commercial sponsor bank. The heavy central ownership ensures national developmental goals are prioritized over pure profit.
Bullet point 2, the number 3.
The number 3 represents the strict maximum number of contiguous districts a local area bank is legally permitted to operate its branches within. The RBI enforces this severe, tiny geographic boundary to guarantee that the bank remains hyper-focused on mobilizing rural savings and immediately deploying them as credit within that exact same local community, preventing capital flight to urban centers.
Bullet point 3, 5 lakh rupees.
This is a critical consumer protection figure. It is the maximum deposit insurance coverage amount provided by the DICGC. It covers up to exactly 5 lakh rupees per depositor per bank. This limit comprehensively encompasses both the principal amount and any accrued interest held in the same right and capacity. It is designed to fully protect the vast majority of retail savers without creating unlimited moral hazard for billionaires.
Bullet point 4, 3 months.
This refers to the strict minimum frequency at which commercial banks are mandated to reset the interest rates on floating rate loans that are linked to an external benchmark.
Now, I have to stop and ask, why exactly 3 months? That seems so specific. Why not let the bank decide to update it once a year or maybe every week?
Because, as I mentioned, these numbers dictate macroeconomic mechanics. The 3-month reset window is the precise lever that ensures the efficient transmission of monetary policy.
Okay, how does that work?
Well, imagine the economy is crashing, and the RBI drastically lowers its central policy rate to stimulate borrowing and spending. The RBI wants everyday borrowers to feel that financial relief immediately. In the past, when banks controlled the resets, they would intentionally delay passing on those rate cuts for a year, hoarding the difference to artificially inflate their profit margins.
So basically stealing the relief.
Right. By legally mandating a 3-month maximum reset period, the RBI forces the bank to pass the central bank's policy changes directly to the real economy almost immediately, ensuring the RBI's macroeconomic steering wheel actually connects to the wheels on the road.
That makes perfect sense. Bullet point 5, 6 months.
This is an aggressive regulatory timeframe regarding asset quality. It is the strict window within which banks must deeply review all newly classified non-performing asset, or NPA, accounts specifically to determine the identification of willful default. The RBI refuses to let bad loans sit unexamined in a dusty file. Banks must aggressively and promptly investigate if the default was intentional fraud or genuine business failure within exactly 6 months.
Bullet point 6 is a fast-approaching deadline, October 4th, 2024.
This is the looming, hard regulatory deadline by which all regulated entities must have their internal systems and processes fully upgraded to ensure that all new retail and MSME term loans strictly comply with the new Key Facts Statement, or KFS transparency guidelines. No more hidden fees or confusing amortization schedules after this date.
And the final bullet points regarding the massive Basel III liquidity overhaul, June 9, 2014 and October 1st, 2021.
These are the respective phased implementation dates for the macroprudential liquidity ratios in India. The liquidity coverage ratio, demanding a 30-day survival buffer, officially came into effect on June 9, 2014. The net stable funding ratio, enforcing structural long-term funding stability, took effect on October 1, 2021.
Excellent. Take a breath. We have mapped out the historical dates, we have mastered the dense definitions, we have identified the cast of characters, and we have memorized the hard statistics.
That's a lot of material.
It is. But to truly ace this exam, we need to do more than just recite flashcards. We need to connect the dots. We need to answer the question, so what does this all mean? How do these disparate facts actually interact in the real world to prevent economic collapse?
Right, the synthesis.
Exactly. So for this section of your mental infographic, I want you to imagine drawing literal, bold arrows connecting these concepts to show the chain of cause and effect.
This is where true comprehension happens. Memorizing facts is one thing, but understanding the mechanical, inescapable logic of why a regulation was triggered by an economic reality is what will get you through the hardest, most complex analytical questions on the exam. Let's trace these critical causal chains.
Let's start with the most fundamental chain of the entire chapter. We will call it the fragility loop. How does the arrow point here?
The causal chain flows exactly like this. Because of the inherent socially necessary banking business model of funding long-term illiquid assets like 20-year mortgages using short-term liquid demand deposits, banks suffer from a permanent inherent asset liability maturity mismatch.
And that mismatch leads to.
This mismatch leads directly to the next arrow, which is an inherent design fragility that makes them deeply, permanently susceptible to a catastrophic run the moment public confidence wavers.
Which leads directly to our next chain, explaining why the government steps in.
All right.
Let's map the regulation justification.
Right. Because of the stark reality of asymmetric information where unsophisticated retail depositors simply cannot comprehend or monitor the complex, highly leveraged, opaque balance sheets of their banks, relying on free market discipline alone is entirely insufficient to maintain stability.
Because the market can't police what it can't see.
Exactly. This failure of the free market leads directly to the final arrow, the absolute, unavoidable necessity of strict, continuous banking regulation by the RBI to protect citizens' life savings, ensure systemic trust, and fulfill societal moral imperatives.
Okay, I'm going to stop you there and play devil's advocate for a second, because someone taking a pure free market view might argue this. If regulation is so incredibly tight, so suffocating, doesn't it just choke off innovation? I mean, in the tech world, the driving motto is move fast and break things. They invent incredible things because they are allowed to fail. Why not let banks take the extreme risks they want? And if they make bad bets and fail, they fail. It's a free market, investors lose their shirts, and a better bank takes their place. Why the heavy hand?
It is a philosophically fair question, but it entirely ignores the concept of systemic cost. If a major tech startup fails because they made a bad app, it is unfortunate. Venture capitalists lose their invested capital, employees lose their jobs, but the broader society moves on unaffected.
Right, it's localized.
But if a major commercial bank is allowed to move fast and break things, and it fails, the damage emphatically does not stay contained to its shareholders. The contagion is instantaneous. The fundamental payment and settlement systems of the country freeze. Healthy businesses suddenly cannot make payroll because their accounts are locked. Supply chains halt because letters of credit aren't honored.
So it bleeds into everything.
Yes. You get massive, cascading output losses, skyrocketing unemployment across entirely unrelated sectors of the economy, and even potential civil unrest. The social cost of a bank failure is simply too vast, too deeply intertwined with the daily survival of the nation to ever allow them the freedom to move fast and break things. Systemic risk demands systemic chains.
So the sheer terror of systemic risk is what justifies the heavy hand. Let's look at how that heavy hand evolved globally with our third causal chain, the Basel III evolution.
The arrows here are drawn in the blood of the 2008 crisis. Because of the harsh lessons of the global financial meltdown, which revealed terrifyingly that even banks that were technically well capitalized under Basel II could spectacularly fail due to sudden, severe short-term funding freezes, the global regulatory community realized the framework was fundamentally flawed and completely overhauled it via Basel III.
Which brought in the liquidity metrics.
Exactly. This realization led to the final arrow, the introduction of strict macroprudential liquidity ratios, specifically the LCR and NSFR, alongside traditional capital metrics, forcibly ensuring banks hold massive, unencumbered cash buffers against panic.
Chain number 4 relates to the frustration of the everyday borrower. Let's map the external benchmark rule.
Because of persistent, opaque, and entirely self-serving delays by commercial banks in passing on the central bank's policy rate cuts to ordinary retail borrowers, the critical macroeconomic transmission of the RBI's monetary policy was failing to reach the ground level.
So the RBI forced their hand.
Right. To fix this stubbornly broken pipe, this led to the final arrow. The RBI mandating that all new floating rate retail and MSME loans must be strictly tied to external, publicly known benchmarks, aggressively forcing transparency and instantaneous rate transmission.
And the final causal chain is something that happened very recently, highlighting how dynamic the RBI has to be. Let's look at the consumer credit intervention from late 2023.
Because of a persistently high, deeply concerning, and potentially unsustainable growth rate in unsecured consumer credit like personal loans and credit cards, as well as ballooning bank lending to non-banking financial companies, or NBFCs, the RBI identified severe potential systemic stress actively building up in these specific targeted portfolios.
And they didn't just wait around.
No, rather than passively waiting for these loans to default and cause a crisis, this led to the final arrow. A proactive November 2023 circular where the RBI imposed stringent quantitative and qualitative measures, specifically increasing the risk weights and capital requirements for these exact high-growth loans to artificially increase their cost and cool the overheated market down.
Wow. Visualizing those arrows, those chains of cause and effect, really brings the whole chapter to life. It's not just a list of rules. It's a constant, high-stakes game of action and reaction between a profit-driven market and a stability-driven regulator.
It's an active, ongoing battle.
We are nearing the very end of our infographic blueprint. For this final major section, I want you to envision a very clean, highly structured matrix table right at the bottom of your page. Throughout the deep dive, we've mentioned universal banks, differentiated banks, and local area banks. The exam will absolutely test you on the specific boundaries between them. We need to contrast them side by side.
A comparative matrix is undoubtedly the most efficient way to study this structural breakdown. We are going to contrast these three distinct banking models across four specific defining dimensions: core objective, scope of operations, licensing era, and target audience.
Okay, let's build the matrix. Row number 1, core objective. For universal banks, what is their goal?
The objective is massive, general financial intermediation across all sectors of the economy. They are the generalists.
For differentiated banks, meaning small finance banks and payments banks.
The objective is highly niche. They exist to drive financial inclusion, facilitate targeted remittance for migrant labor, and provide basic savings to the chronically unbanked.
And for local area banks or labs?
The objective is competitive financial intermediation, specifically focused on mobilizing and deploying capital within targeted rural and semi-urban areas.
Excellent. Moving down to number 2, scope of operations. For universal banks.
The scope is vast, nationwide and frequently operating international branches.
For differentiated banks.
The scope is also nationwide, but it comes with severe, specific regulatory restrictions on their daily activities. Most notably, as we defined earlier, payments banks have a nationwide scope but cannot undertake any lending whatsoever.
And for local area banks.
Their defining trait is that the scope is strictly, legally, geographically restricted to a maximum of 3 contiguous districts.
Row number 3, licensing era. Let's tie this back to our timeline. For universal banks.
They evolved out of the cautious stop-and-go era of 1993, 2001, and 2013, and have now matured into an on-tap licensing policy framework.
For differentiated banks.
They are the modern experiment. They were formally introduced post-2014, and currently, small finance banks have proven themselves enough to also be granted on-tap licensing status.
And for local area banks.
They are a relic of a specific inclusion initiative conceived back in 1996.
And our final row, row number 4. Target audience for universal banks.
The audience is absolutely everyone. Massive, multinational corporate giants, everyday retail consumers, wealthy individuals, government bodies, all segments.
For differentiated banks.
The audience is meticulously targeted by design. Small business units, small and marginal farmers, micro-industries, and the vast unorganized sector.
And for local area banks.
The audience is deeply local communities, rural agriculture networks, and low-income households specifically located within their 3 designated districts.
Seeing them laid out side by side like that perfectly illustrates how the RBI attempts to cover every single inch of a massive, diverse country. But I have one last question about this matrix before we wrap up.
Sure.
Say a small finance bank does exceptionally well. It achieves its inclusion goals, it grows its deposit base safely, it manages its risks perfectly under the RBI's watchful eye. Is it structurally trapped being a niche SFDE forever? How does a differentiated bank break out and graduate to become a universal bank?
That is a crucial question, and it is exactly what the April 2024 regulatory guidelines addressed. The matrix we just built is not a permanent, inescapable prison. The RBI established clear, rigorous eligibility criteria for upward mobility.
So there is a path.
Yes. If a small finance bank proves its mettle over a specified multi-year track record, expertly manages its asset quality, maintains robust and transparent corporate governance, and can meet significantly higher capital and net worth requirements, it can essentially apply to transition up the matrix. It can convert into a fully fledged universal bank. It provides a massive structural incentive for exceptional performance, ambition, and most importantly, stability within the differentiated sector.
Unbelievable. We have done it. We have reached the end of Chapter 7.
Oh.
Listener, I want to formally, genuinely congratulate you. You have just survived the ultimate, most exhaustive exam prep deep dive imaginable. We have meticulously built an incredible mental blueprint today.
It has been a massive, intellectually demanding journey through a profoundly dense landscape. But look at what you now hold in your mind. You have the full historical timeline, tracing the evolution from the chaotic 1850 Companies Act all the way to the precise 2024 KFS Transparency Guidelines.
The whole history.
You possess a precise, exam-ready glossary covering the deepest complexities of Basel III, LCR, and IRBP. You know the exact cast of regulatory characters, the critical hard statistics and timelines, the underlying cause and effect mechanics that dictate systemic risk, and a clear comparative matrix of the varied barking models.
We promised at the beginning that you wouldn't need to read that wall of text again. And if you can visualize this blueprint, you truly do not need to. You have the mechanics locked in. But as we wrap up this deep dive, we always like to leave you with something to chew on, something that pushes just a bit beyond the textbook and into the reality of tomorrow.
We have spent this entire extensive discussion outlining how regulations, capital ratios, and liquidity buffers are meticulously built to maintain stability, but there is a dark truth to regulation. It is almost always built to prevent the last crisis.
Oh, that's chilling.
Looking back at the fragility loop we discussed, a bank run in 1930 meant panicked people physically standing in the line outside a brick-and-mortar branch, which gave the bank time to react. A run in 2008 meant people logging into slow web portals to wire money.
Still somewhat manageable?
But think about today. With the rise of AI, decentralized finance, algorithmic trading, and instantaneous digital banking, we are living in an era of light-speed bank runs. A panic can be generated by a single rumor on social media, and billions of dollars can be seamlessly moved to another institution via a mobile app in literal seconds, as we saw with recent banking failures globally.
Wow.
So the ultimate question I leave you to ponder as you prepare for your exam is this. Can a regulatory framework that is fundamentally built on reviewing quarterly financial reports, conducting 30-day LCR stress tests, and relying on historical capital buffers, can that system physically move fast enough to catch a systemic crisis that is now moving at the speed of light?
A system engineered for structural fragility, violently meeting the frictionless speed of the digital age. It is a terrifying yet absolutely fascinating thought. Thank you so much for joining us on this deep dive. Keep studying, keep trusting your blueprint, keep asking hard questions, and never, ever stop examining the invisible systems that run the world around us. Good luck on the exam.